This is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, February 3rd, 2026. It is 9:58 a.m. Eastern Times. I'm starting the video, and here's what we're going to do in this one. We're gonna start out here. Bear with me. I'm trying to put my phone on mute, so I don't get a phone call during the video. All right, that's done. Sorry. So we're going to start out here with BIZD. For those of you who followed me for a little while, you'll recall back here, long before most even knew what a business development company was, long before the media was talking about it, and long before Jamie Dimon talked about when you see one or two cockroaches, there's usually more. I started zeroing in on this sector and predicting that a break of this level would be bearish and trigger downside. And this is a sector, one of, you know me, always looking for when you have a stock market all-time highs, talks of a bubble, whether, that's debatable or not, in AI and in credit bubble too. People don't, that's the thing. I think a lot of times all eyes are on one thing, and many miss that there might be a bubble somewhere else. So private credit and private equity, both very, very much related. A lot of private equity companies also have their hand in this cookie jar. But as the name implies, it's credit, debt. So this is where you go when you can't go to the bond market. And this is one of the what we call the shadow credit areas of the market. These folks get a mark their loans to fantasy, which means pretty much they might think that, oh shoot, we're taking a bath on this one, but we're just going to market it at 99 cents or $1 on the dollar, because we need to make our quarterly numbers. And if we start spooking the markets by saying we need to mark this debt down to 50 cents on the dollar because there's increasing odds that the issuer is not going to be able to make payments, then it's going to have a ripple effect. So either way, just, we can debate all day long how ethical many of these companies are, whether they're even aware. But remember, the long since we broke that, or shortly after, I should say, and I gave you 4 price targets, all 4 were hit. We even turned around, reversed it there with impunity, gained the first 2 targets. I removed that third I gave you. And again, I've covered this many times. And we ultimately went up to hit that third. But here's where we're at, and here's why I'm doing the video. We're back there, and there's not a day that I don't watch this one. I have a watch list I've shared with you guys over the years. I call it my TTW, or Things to Watch list. And this is very much in there. Because again, there's things to watch that if they're doing well, that helps support the bullish thesis or narrative on again, maybe the whole market. It's a collective, kind of an eclectic mix. I have things like FedEx and UPS because that's usually a tell on how the economy is doing. If their business is up, things are moving around. People are buying a lot of things, moving things, closing documents for mortgages and packages being shipped and all that. Paychecks and ADP, very closely watch those, which are 100% singing a different song than the government statistics are singing on the jobs market. Home builders, you name it. Anywho, this is one of them, as should be. And again, take of it what you will, but we're back to that level. Remember, this is not some arbitrary level. This is, and please remember, this is with the S&P and Dow within, even the NASDAQ not too far from it, spitting distance of not 52-week highs, all-time highs. So if these guys are at a 52-week low and about to, on the verge of breaking down and making a new multi-year, even all-time low, well, not all-time, that's COVID right there, when the world came to an end and stopped turning for a couple weeks. But either way, that's it. So it's the same level. Not tweaked that line since August of last year, and that is was the final target. And to me, it's a very significant support level, especially since we've already checked it a couple times. The way that price targets and support levels work is the more you tap on a support level, the more likely it is to ultimately go. Now, I'm going to say what I often say. I have a lot of yogiisms. You guys know that. I repeat them frequently. support is support until less broken, right? So you can look at this one of two ways: glass half full, glass half empty. Even if you don't have a horse in this race, you don't want to trade it. If you're optimistic on the market, then you'll say, okay, well, it's support and maybe a slight punch through, because I will acknowledge that. Here we had a slight punch down through, followed by a quick recovery. Any new low will still be a divergent low, just like this last one was a divergent low. But that divergent low, it gave us a rally I was looking for from a technical perspective, nice ABC. But that's typical of a corrective wave. If you're an Elliott waver, corrective waves, meaning a bounce or a counter trend bounce and a primary larger downtrend, typically takes the form of an ABC, three wave pattern like that. All right, so let's not spend too much time on it. Something to watch. This time around, I'm not shorting it, at least not at this point in time. Those are the old trades. I'm more highlighting this as something to watch for the equity markets that will peer back on the radar. And I think we even saw it with Moody's down today. That's also MCO is also my watch list, and they're down quite a bit, related probably to this most likely. I'll have to check the headlines, but that's it. So any new low will be a divergent low, and that doesn't guarantee that you reverse, but it has a potential. So again, at this point in time, I just wanted to point it out. And again, you have to ask yourself, and Jamie Dimon was the one that came up down here when everything started moving out. Yeah, usually when you see one or two cockroaches, remember guys, it was Tricolor and then First Brands. First Brands automotive parts, Tricolor an automotive dealer, lending money to people that absolutely shouldn't and wouldn't able to be qualified for a car. They were giving car loans to illegals largely. That was their business model in Texas and all that. How'd that work out when the current administration cracked down on the border? Plus, that kind of really puts the brakes on their ability to pay back. And so, but again, to me, the bigger thing, and I think to others, was how did it come out of the blue? And that's what, again, I'm going to keep talking on the fact that private equity and private credit have the ability, unlike publicly traded companies who have a fiduciary responsibility, must have an auditor, and you can, if you cook the books bad enough, you'll go to jail. All right. But in private credit and private equity, it's the norm. They get a mark to market. They get to value those loans as to what they feel that they're worth. I think that's coming to roost right now, showing that, again, the markets speak. Let's get off it. Just watch it. We're at support. Support is support until unless broken. So maybe they bounce. Maybe there's a little flush out move followed by a reversal, or maybe this breaks down, and which again, traded enough business cycles, enough crashes and economic meltdowns in the market to know that the financial markets, especially the debt markets, which are more important than the stock market. It's larger. The bond market's bigger than the stock market. More important, debt is the grease that keeps the wheels of the stock market and the economy humming along, right? And so a blow up in one area, on one fund, one private credit company. But again, remember that pension funds and hedge funds have been knee deep in this, had their arms knee deep in this cookie jar for a long time as well. So you can have those ripple effects. That's all I'm going to say. Hard stop. We'll just watch this. And believe me, I watch other, what I call subsectors of the financial markets. I watch private equity as well. I watch regional banks. I watch the big banks. I watch the specialty lenders, you name it. And that's it. So let me just point that out to you guys, and I encourage you to keep an eye on this. If we break that support, and especially if we start waterfalling, and you can pull the individual components. Let me just take a look here today. Who's down the most? ODB Blue Owl just keeps waterfalling lately, and it's had divergence there. That's when we went long and reverse and gave them to bounce in the sector, and just about all of them bounced, and it has divergence again. But as I often say, another one of my yogiisms is the road to a bull market is paved with negative divergences. In other words, you're going to get those divergences. quite often those negative divergences are good for corrections, especially on the 60-minute charts, even the daily. Good for corrections and pullbacks. That's why I'll trade, give me a bull market, I'll trade it long short. I'll short the corrections, short the pullbacks. But what tends to happen is negative divergences in a bull market are either completely shrugged off, meaning they don't play out, you just keep going up and the divergences are taken out, or right as the correction starts to look good and feel good and starts to look like it's getting going, they step in and buy the dip. And that chart pattern, if there's one, will fall usually shy of its measured target. Likewise, in reverse, a bear market, as I like to say, is paved with positive divergences. You're going to get them. And early on, they usually start to play out. And as time goes on, they play out less and less. And then finally, when you know the bear market's upon you, when you have a beautiful setup, nice divergence, especially if you were at support, long-term support, and you just burn right through that like it's not even there. Okay, so watch this one. Watch them all, really. I have when I key in a sector or an ETF that tracks a sector, BIZD, I have it, and I very much watch the individual components. There they are right here. And I have another watch list I created with additional business development companies that might not be in this particular ETF. So that's it. At support. Support is support until unless broken. So it's not a freak out moment. It is, again, something to monitor and watch at this point in time, in my humble opinion. Other things I'll continue to watch and monitor, and I don't update every day because there haven't been a lot of updates in the last few days. Silver and gold have been the big movers in the market. Tremendous, profit potential there in short order. The stock market, including the market leading index QQQ, continues to go absolutely nowhere. I'm going to turn off all the lines and just illustrate that. So if you are frustrated trading the markets, if that's your only trade, meaning QQQ, SPY, the futures, basically we're at, as you can see as I take that the crosshairs across to the left, we're just about where we were back in the beginning of October. Okay, so that's almost 4 months ago. QQQ went up a little, went down a little, went up a little, went down a little, and it's been compressing. So one of the many sayings I come up with too is, in life, patience is a virtue, and trading it's an absolute necessity. So just like we waited for the sell signals on gold and silver, and then last Thursday night I got that post out to you that a crash appeared imminent, likely to start as early as tomorrow, meaning last Friday, which it did. Boom, that's, this thing is sooner or later going to break out. My thoughts, an upside break on face value until unless it fails is going to be bullish. But an upside break will only extend the divergences that were in place at the previous high, therefore leading me to believe that that breakout will likely fail, and we don't have to break out. In fact, we've already had a breakout in the S&P 500. Failed once. It's just going nowhere. We're just, it's not bearish, but it's not bullish, right? Of course, we've gone nowhere now. The S&P is a little higher, and it's higher because of one, largely, not exclusively, but primarily due to one sector, the financials, which lifted it towards the end. They passed the baton a little. They've come in a little bit here, but you guys know this is my level here. And if private credit breaks, that's why I'm starting the video. I'm trying to loop all this, thread it together, because they're all interconnected. If private credit breaks, really breaks, and there's a blow up there, it will most likely spill over to this sector, spill over to the regional banks, spill over into the equity markets as a whole. So that was the breakout to new highs right here, breakout back test, and then it failed. We went down, we hit my 53.10 support, and now we need to take out the trend. Well, we need to take that level out, $53 with a solid close. Take out the 200s, and then this is the lights out level, at which point I believe the market will be in free fall, and we should go and hit my second target, which, forever and a day, it's the same trade from back here. 1, 2, 3, multiple short entries. We hit, it's all moved. What happened here? Something's going on. Oh, No, it was on this time frame. This one. Yeah, that's it. One, two. All these were highlighted as objective short entries, and we hit the first target. We bounced. We basically came in and retested that previous back test of that uptrend line, and so it either plays out or not. Sometimes you get locked in these trading ranges or consolidation periods, and again, that's energy building like a coiled spring. So that's the way I think it's going to go. We're going to look at the leaders real quick. NVIDIA, remember, is an outlier, the Mag 8. They don't report until the end of the month. But you do have Alphabet, which has been best in show, best in class, best in breed lately of the mags. Just fresh off a new all-time high today, right? Literally today, but nothing but back testing. Now, that's not necessarily bearish. It is. That was a breakdown. Let me be very precise with my words. That was a sell signal, but it also came just in front of earnings. As I often say, stocks are only going to move so much in front of earnings. So take any breakdown or breakout with a grain of salt. So I'm very much eager to see where this stock goes after they report tomorrow after the close, and I'll play the game I always play every year during earnings season on the big bag eights. Based on my analysis on this chart, that's going to be to the downside. Why? Because you had a beautiful, well-defined uptrend line, big negative divergence. And again, I don't care what happens the night of the report or even immediately day after. I'm talking in the coming days to weeks. In other words, I'm talking that it's 10% plus will most likely be to the downside versus the upside. And at minimum, I think this one's going to come back and test the 200s. Even if I was put on my bull mask right now, I would tell you, if I was longer term bullish looking for big gains in 2026, I would wait for a pullback to the 200s, because that's what you do in a bull market. When you get too far away, I've showed you many times in the past, you can put that indicator up. I've created a custom indicator here to show you the percentage trading above its 200-day moving averages. This is as far as I can roll back on the daily chart. This hasn't been seen in years, maybe in history. I don't know, really, since Alphabet came public. I can show you another one. We'll look at it. So that's an extreme. This is the normal level right here, right? You can see this blue line I'm drawing. This is typically about as far as Alphabet gets above its 200 before it comes in and has to check it. Think of that level kind of like a little magnet or whatever, or a tether that it's attached to. And, even in bear markets, it goes down and you get extremely below the 200 and you come back and test it, right? So that's that. And you have the same thing on a weekly chart. I can show you. You just have to key it in and make it, again, it's a custom indicator I created. You're not going to find this on TC2000, but you can create it on any platform. I can show you how, walk you through how I do it. Some might have it now, I don't know, but I believe that's a custom one I created. So I'm rolling back. Yeah, we're going back. This is when the stock, this doesn't really count, and I'm not being dismissive to fit my narrative. Let me change the color tool. I'll just leave it there. This back here, because the way this charting platform works, the 200 doesn't start populating to right there. So this is when the stock came public. Alphabet came public back in 2004. So initially, it's going to kind of skew these readings till you have some period of time where the 200s or 40-week moving averages have been calculated. They need past prices to come up with that. So pretty much since the stock in modern, since the stock came public, we go back here. Again, you can see what I'm talking about. So for those of you that don't think there's a bubble, that don't think there's a problem, again, I go off technicals. We can sit here and debate all day long, and bulls have their their valid points, and bears have their valid points. I can tell you, I first and foremost put the heaviest weighting on technicals, and this is the most extreme overbought reading based on this indicator and some others that the stock has ever done. And so it's similar to, and again, it's part of the AI hype, the AI bubble. AI is here to stay. So was the .com or the internet back in the 90s when the .com bubble happened. Problem is, everything just got priced not to perfection, but way beyond perfection, way ahead of themselves. So as you recall, the NASDAQ fell about 80%, and the likes Alphabet wasn't trading at the time, or Google, Alphabet now. So that's that. Let me move on. Okay, so well, QQQ goes nowhere. QQQ, the canary in the coal mine, I always say for the tech sector, are the semis. And the semis have just been, again, the biggest beneficiary, hands down, of the AI bubble. NVIDIA being the king of that sector. This being the SOXX, the ETF, there's several out there. I follow all three, the big ones. SOXX, which tracks the first true semiconductor sector. You can go back to the 90s and track the Philex SOX semiconductor index. But the problem with it, a lot like QQQ, I mean, it's a good problem to have when things are hunky-dory in the sector, but it's very skewed to the top weightings, NVIDIA being about 8% of it, AMD 7.5%. So all the big semis that are the biggest beneficiaries of this AI circle jerk money going, from the big tech companies, Amazon, Alphabet, Microsoft, into these guys. It lifts them up, but it'll also be the anchor that pulls them down on the way down. So, and it did, as I recently told you, broke down this minor trend line here. We had a minor trend line break there, a correction. We had a trend line break and back test there. So the divergence, this is all one big divergent high that we keep diverging. Divergence isn't a sell signal, but what is are breaks of support. So we do have that one recently. And remember, when you take out, the closest thing is a lot of times I'll, in my analysis on the S&P 500 or NASDAQ 100, I'll go over the equal weighted indexes. They have those. And that kind of gives you an idea of, the impact that the top Mag 8 super duper heavy names have. Well, I'll do the same thing in the semis, and this is XSD. This is what I would consider the closest thing to the equal weighted. The S&P. It's managed. It's from the S&P semiconductor sector, and they take a much more diversified approach. They have a lot more holdings. They have 43 holdings, and you can see here. It's much more balanced. The top holding, last time I checked on January 5th, a month ago, Micron was 3%. You can see they're all about equal weightings there early on, and much more balanced. And that one I just wanted to point out. So if you want to know when the sector goes, again, NVIDIA is probably going to do what NVIDIA does up until earnings. There could be a pre-earnings sell-off or pre-earnings rally. I don't know. We'll watch it. But there's a nice wedge forming right there. That uptrend line off the April lows. And here's our divergence line right there. Negative divergence. Been building. And so, and a nice price support level, about 340. Everybody loves round numbers. So let me tick that up a penny. That's 347 right there. What that was. Basically, you had this new highs breakout which failed, then they on the run back to 347 it pulled back, and then finally it broke out recently. So once again it's above there, and so now a failure back below that 347 support will also coincide with a break of this uptrend line, triggering a pretty decent sell signal in my opinion, and take us down to these that's about 310. Again, everyone loves those round numbers, so I just put the lines where I see they need to be, but move that one up to about 310, maybe a little higher. You could say 310 up to about 315, then the 200. So we'll watch that. But guys, let me get back, and I'll keep this video so it won't go on too long. Let me just get back to the leaders. So NVIDIA, again, if you're new to the site, we've been in this multi-month trading range. By no mere coincidence, the NASDAQ 100 has been in a multi-month trading range. We had a breakout that, as predicted, would fail. Divergent high, negative divergences, overbought conditions. The breakout did fail. Sent us right back to the bottom of the trading range. So that is my big level there. It's about 165.50, give or take. You have the 200-day moving averages coming in as well. I can think of no better sell signal on the most important stock in the entire stock market right now. The largest in the world by market cap, largest publicly traded company, largest component of the NASDAQ 100, largest component of the S&P 500. Hard stop. That's it. So this is nothing but bullish for the stock market. This is nothing but bearish for the stock market. There's really no in between there. Alphabet, I already spoke to that repeatedly. Back testing, I'll give you my expectation. Apple, Beautiful little trade, shorted there. Got in a bit early, but not wrong because we never exceeded our suggested stop. Then hit our third and final target with impunity, in which case I suggested covering that short and or bouncing it because we hit the 200-day moving average at the same exact time. You hit my third target, which was initially based just on a price level. Had no way to see when we initially shorted it when the 200s would come in. So the fact that the 200s came in, the 200 exponential came in with support. It's a beautiful level for Apple and a lot of tech stocks. They just behave, is the word I use, so well when you're below it. It's resistance during a bear trend, and when you break it, that's nothing but bullish. And you could see that Apple was off to the races after this bear market correction here, whatever you want to call it, was over, and it was recovered. So that was just the first test in a long time. So it's a level that I expect will go, and all I can tell you is when it does, especially the 200 simple that's a little below it, that should be lights out for Apple. And Apple's still a very, very much a crowd favorite. NVIDIA might have dethroned it as the largest publicly traded company, but Apple's just right there, not too far behind at 3.8 trillion right now today, with NVIDIA at 4.6 trillion. Microsoft, this is why I did the video today. I had an alert fire off today. I may tweak this trend line or I may leave it here. Let me just show you what I have here. I'll hand draw it in for you because I know that's a busy board. So you have a trend line here off the October 2022 lows. I start there, I catch that first reaction point, this major reaction low. And so that's why if I tweak it, we're above it. So that's probably the safe bet. I always tell you the charts are dynamic, so is my analysis. So I'm going to do that right now, give Microsoft the benefit of the doubt because it's such a busy board. It gets hard to see because I have all these little micro support levels. But I'm going to grab that trend line if it will let me. Sometimes it's a little over outside the margins there. I must have put an extension on it. I sure did. Turn that extension off. Pull it out here. Come in, hit that low, and that puts us right there right now. We're right on the trend line. So as I like to say, support is support until unless broken. If you are bullish on the market or bullish on Microsoft or just looking for one to bounce, like a couple weeks ago, Apple was the best bounce up. In fact, we did the same thing. I gave you Microsoft as a setup right here recently. I forgot about that. I gave you a total of 3 targets, but when we hit T2, it was about to report. So I said, nope, that's it. Time to get out because we're too close. It's not worth trying to milk that extra 2% or less in front of earnings. And so that's it. So right now it is, by the skin of its teeth. These divergence, the blue line will change on the PPO by the end of the day if Microsoft reverses. So there's another bounce up for you in Microsoft. You go long at trend line support with a stop somewhat below. Ideally on a closing basis, that'll help prevent stop raids if they take it down, only to run it back above there and stick save it by the close. Bounce targets, well, I'd see right about here. Let me move that up for you. About 40, minimum target. That's just the first resistance level right there, if you're so inclined. But let me show you one other indicator before I don't have strong convictions on this. In fact, it's a trend line that I suspect and expect will go sooner than later. So therefore, there comes a point when you stop trying to game the bounces and you recognize, because that's the nature of when a trend has changed. It's painful to the dip buyers because they start buying dips like Pavlov's dogs. And then they start to realize, I call it the POR, another term I've made up, point of recognition, where they realize rut row, like the Scooby-Doo rut row, something's wrong. I keep buying these dips, yet I keep digging myself in a hole. I'm going underwater and I'm adding more and more. The stock isn't going to new highs anymore. And then they start to give up and then they stop buying the dips, right? And so, are we at the point of recognition? I think if we take out that trend line, it's going to be clear to pretty much the masses. So that's it. So there comes a point where you want to stop trying to buy dips if you think that support level is going to break. Sentiment continues to get frothy as this is one of my favorite sentiment indicators, the CPCE. There's various put to call ratios out there. There's the CPC, which is the general put to call ratio, measures all put versus call buying, puts in a ratio. Then you have the CPCI, which is a put to call ratio only on the indexes. Typically, that's used by institutions to hedge. And then the CPCE, which is the equity only. So think of all these retail traders, the markets, as I've talked about, and I'm surprised it's not more in the headlines, has become an outright freaking casino. That's the bubble that I think most miss. And I don't hear or read or see enough conversations about that. It started with it started after COVID hit. Everybody got checks, whether they needed them or not. You got sent a check. Your business was booming. You got a check on the PPP. You got paid if you did nothing to sit at home. And so what happened? That's when the Robin Hoods, which still is one of my favorite shorts of the world, and those type platforms popped up, and you had these I don't stereotype the demographic, but pretty much armchair investors. And it started with the meme stocks. Before that, it was crypto. So crypto is nothing. It's nothing but bits and bytes, and like Charlie Munger said, the currency of drug smugglers and human smugglers and drug dealers, right? And then of course Wall Street legitimized it because they saw anything where there's profit potential, they don't care, and so they've legitimized it. And there's futures now and ETFs and all that. And then you had the meme stocks right after remember COVID. That's where the meme stock thing started. Before that, I don't think there was a term meme stocks. GameStop and AMC and all these other ones popped up, right? Then you have what you have now, what it's evolved to. No, the proliferation of single day options where you could bet on the market, anything, a stock, the market, whether it was going to close up or down for the day. That's out and out gambling, guys. That is out and out gambling. There's no, options and futures. They all started back in the day as, legitimate hedges for farmers to hedge their crop, their crops that they were going to bring to market: corn, wheat, soybeans, crude oil, natural gas, crude oil futures. Airlines could hedge to prevent, because that's always been their second biggest expense, right behind labor, is fuel. So they could, to help smooth out their earnings and unpredictability of volatile fuel costs, they could hedge. And of course, everything now has become just taken over by speculators, is pretty much the way I see it. And if the proof is in these, not to mention, I'm here in Florida, you see casinos going up everywhere, pushed to legalize gambling, and throughout the country. And you also have now these betting markets. You can bet on anything you want, whether hurricane's going to hit, how cold it's going to be tomorrow, who's going to win the midterms, who's going to when what's her name, freaking Travis Kelce's wife, the singer, whether they're going to get married or again when they're going to get engaged, all kinds of stupid stuff. And that's where I'm seeing a very concerning trend going. So where I'm going with this, I know I'm rambling here, is this is a put to call ratio, and it shows sentiment. And so this is a line I've had here for years. Back here, this is, and I like to put this, it's a 100 period moving average. So it's a simple moving average. It's something years ago I came up with. I tweaked it where it helps smooth out the erratic. This is your buy zone. This is extreme fear. This is when you want to cover shorts and go long. And this is the sell zone, extreme complacency. And quite often it's more of a range when you have persistently low readings. Then finally, after persistently low readings, the corrections come. Sometimes it's more one and done. You had a cluster of 3 there. I'm just going to read them out. You had a 21% drop there. Then you had a cluster here. A first one hit right around COVID, but then you got that was one of the biggest bear markets and certainly the longest since the financial crisis right here that we had back in 2022. And now you can see we have persistently low readings again. And so I also look at that 100 period moving average. Once it falls to this level, you can see all the I'm circling them here, the biggest drops, including the financial crisis in years. When you get to that level, there's a lag time. That's it too. That's what's noted on here. It's not an immediate. This is not a timing indicator. Far from it. Sentiment is far from an exact timing indicator, but you can see when you hit it here, eventually the top comes. We cross that line here, and we're at a pretty deep level. We're about this far into it, and which is about as far as we were into it right there when the top came back in 2020, late 2021, early 2022. So again, it's more of these are conditions, and it's not an exact timing indicator. It's just showing us that everybody, the majority of traders are very complacent and expect the stock market to continue up and don't have a lot of fear. When they have fear, they start buying a lot of puts, and you spike up to here, and that tells you, hey, you want to start covering those shorts. When everyone else thinks the world's coming to an end, the sky is falling, that's when you want to be buying, right? All right, so that's that one. And then one more I want to show you. Okay, this is one I created many years ago. Shared it with you over the years on the site many times. It's what I call my custom NASDAQ Hindenburg indicator. I didn't come up with the Hindenburg indicator. It was something somebody came up years ago. No, it wasn't anybody. I don't believe his name was Hindenburg. I think it was a reference to the blimp explosion, the Hindenburg blimp. But anyways, basically what I did, that was created and used off the NYSE, which is antiquated index, and NASDAQ to me is the most important. So I took the same criteria and morphed them over to all those indicators to do only with the NASDAQ. Because again, that's to me and has been for really since the 90s, the most important index. Tech is everything now. And again, it's evidenced by look at the largest companies by market cap and the most profitable. So it gives you a more concentrated view of what's important in the market. So, there it is. So basically the conditions are here. You don't get signals often, but I did have a few a cluster recently. I'm going to drop it down to more recent. Let's go back to the past 9 months. What was I looking at here? We'll do 6 months. Okay, since the big drop there, and remember, that started long before Trump stepped to the podium and announced tariffs. We were already short. We're gaming that thing down. And then I gave you a lights out level, which was triggered that night, right he was talking, a level in the futures. And then that was where I said markets would plunge if that level was taken out. And they did. And then we covered everything on the April 6th lows, 7th, 6th, whatever that low was that. And leading up to it, the Friday before, and then that Monday of is when I posted, hard long, cover all shorts with a full long position. But then since then, it's been just a unidirectional, almost no volatility up. But we've had one decent correction. And yes, certainly took some pot shots at a couple along the way. Some panned out only for the first target of 2 or more. Some didn't pan out at all. But this last one we did, and I gave you 2 on the daily chart. This is what we're looking at here, daily chart. 2 targets, near-term swing targets, I call them. And that was right here, and I'm going to put the crosshairs when we peaked. We peaked right around the beginning of November. You can see down here, right? And again, it was a combination of multiple sell signals, and they were initially, most of them based on the 60-minute and the daily chart. But my point is that was the biggest drop. It's not much, but it's the biggest drop by far in the last year or so. I'm going to measure it from top to bottom. It was a drop of about almost 9%. So a lot of folks felt pain if you were on the wrong side of it, or pleasure if you were on the right side of it, meaning being short. But again, you can see visually the biggest drop, right? So here's my Hindenburg. Back to that. I zoomed in. All right, I did that thing where I paused the video when I was covering one section to collect my thoughts and move to the next part. And the recording button, this time I think I just forgot to hit it. Not sure if I just covered my put to call ratio with you. But that is signaling extreme complacency, the CPCE, equity only put to call ratio. If I didn't cover it, I'll just include a chart maybe below this. video in the comment section. This is another one that I created years back, many years ago. I didn't come up with the Hindenburg omen, but what I did come up with, because I realized back then the Hindenburg omen was created based on the NYSE, kind of an antiquated index. To me, it's just flawed in the purposes of this. Tech stocks are everything. The largest, the top 8, the top 10 largest companies are all tech. NYSE, again, is a more diversified index. Tech is, even of the S&P 500, it has by far the largest concentrating. They're your earnings juggernauts. They're your multi-trillion-dollar companies, the behemoths. And again, when I say tech, I'm including, NVIDIA, Alphabet, Apple, Microsoft, Amazon, Meta, Broadcom, Tesla, what I call the Mag 8, top 10. And so, again, nobody can argue that those haven't been the biggest drivers of the stock market returns in the past several decades, really since the 90s. They've just outpaced all other sectors, financial, everything else. All right, so basically this is it. I just took an indicator that was created way back when. I had a pretty good track record back in the day of predicting crashes. It's a crash indicator. And again, it has its flaws. It can fire off signals that don't pan out, but quite often, and I'll show you here, back in November, this is November right here, the start of November, you might not be able to see it. I have 3 lines in close proximity. That means the triggers were met. And again, I'll show you the triggers in 1 second. I'll zoom out. I don't think I was recording when I started covering this chart. Then I realized as I'm talking about it, the recording had stopped or been paused. But I just want to say I have 3. 1, 2, I haven't even added a line yet because it was yesterday. I haven't updated this since 2 days ago. 3 back-to-back signals triggered, all criteria met. And those criteria are, I have to go back out here, jump back, go out 15 years, and you can see this. Pretty much that's it. The McClellan oscillator needs to be negative on the same day. The daily number of new 52-week highs and new 52-week lows are both greater than or equal to 2.8 of the sum of the NASDAQ issues that advance or decline that day. The number of new 52-week highs cannot be more than the number of new 52-week lows, though new 52-week lows may be more than double the highs. And the NASDAQ composite is greater than value than was 50 days ago. Originally expressed as a rising 10-week moving average. So I put a 50-day moving average. Either way, those are the criteria. Again, I morphed over, just borrowed from what the Hindenburg is based off the NYSE. And I did this years ago, and I've found quite often. And I just showed you. Let me drop back down again to where we were. Go back to the last 6 months. And like I said, I had a cluster readings right here, right back in the beginning of November. This is what I was covering. I don't think it got recorded in the video. So, since the April lows, it was a pretty steady eddy, lift in the markets with hardly any volatility. This is by far, you don't have to sharpen your pencil and do the math, by far the biggest correction since then. We certainly took a few pot shots along the way, trying to short pullbacks. Quite a few hit, they were based usually on the 60-minute charts ever since we cleared the 200s. We had a couple of short trades. I believe they all hit at least the first target, and then without going down to the next or lower targets, then exceeded the suggested stop or any reasonable stop using a 3-to-1 better RR. Then this one here, we had multiple entries. One there on the break of the purple trend line, then the next on the back test of the purple trend line, then the break of the secondary trend line. We went on to hit my first target right there, T1, and that was it. That was that biggest drop. And again, the point was that was triggered. We had a cluster, and that's what you want to look for on the Hindenburg. One usually doesn't do the trick. It's a cluster. And that whole thing is based off wonky doings in the with market breadth. That's what the crux of it is. If you read through those criteria I just showed you, they're unusual conditions that don't often happen. When they do, says, hey, something under the hood is maybe not well. So either way, I just want to point out we had 3 consecutive days in a row recently, and so that increases the chance that we could get a sudden move down, comparable to crash like we just had in silver. I don't expect it to be nearly as big in silver went parabolic, so I expected much bigger crash. And again, the technicals come first, then there's usually fundamental catalysts that will align with it. Just like in silver, they tried to cite media. Not a single person I saw what we saw when I got out to you Thursday night. It was a clear break, parabolic trend line, and then the near-term uptrend lines on the and price support on the futures. Right, that was the technical catalyst. So we were able to get in before the news broke on Trump's announcement of his new Treasury pick for chairman. And so again, that's where fundamentals and technicals, they almost always align quite often, but the breakout, be it bullish or bearish on the technicals, again, will coincide with something. So the only thing I can think of right now on the counter, or there's always something that can come out on the economic front, or a tweet from Trump, right? Anything, he's wild card with that. But Alphabet earnings, I think Alphabet, who is, again, I keep calling them best in breed, best in show and class, putting a new all-time high in today, but back testing the trend line. So I think a shitty report or earnings guidance, it doesn't even matter. First of all, I always expect them to blow out. It's like Apple when they march out when Cook. When Tim Cook walks out on stage, it's always the latest and greatest and best iPhone ever, right? Yeah, no shit. You're going to go back a generation. You're going to put a smaller battery in, worse battery life, less screen resolution. Of course, everything's going to be an iteration. Alphabet, Meta, these guys, they'll become a point where earnings will contract and go down. But so what I'm trying to say is I expect nothing less than a blowout quarter, record quarter. Yeah, they may hit or miss in some categories. It doesn't matter whether they blowout way, beat, miss earnings. All that matters is the market's reaction. And so again, it's just one of many things that could be the catalyst. I already started the video talking about the BDCs, right? Business development companies. So a lot of things can take the market down. But I'm just trying to highlight the things. So what I try here, very hard to do, is be very precise with my timing. I may talk, how long did we talk about the bearish setup on gold and silver? Waiting for those the parabolic uptrend lines to break, and waiting for sell signals even before then on the shorter term charts of the futures. And it's the same thing here. So whether we pop, whether Alphabet goes up post earnings or not, again, I'm more concerned with how it trades, not the night of, although that certainly it has a potential if you're down big enough, but in the coming days to weeks afterwards. In other words, the next 10%, as I like to do, predict looking at the chart. This chart to me is clearly bearish, breakdown back test, and whether they pop it post earnings or not, I think the next big move will be to the downside. And again, I think I already covered it. It's got to come back and check its 200-day moving averages. And the farther it gets away from them, the more painful that mean reversion is going to be. Just to come in and check the 200 exponential, which is the red one you see right here, faster moving in the two. It has to drop from where it's at right now, about 26%. So if it pops 10 post earnings, then it's got about 35%. And I give you very, very few guarantees in trading, very few. But the only one I ever give you is I'm going to be wrong. I'm going to be wrong a lot. So you do your thing with stops, position sizing. But the one guarantee I will give you is Alphabet will, at some point in the not so foreseeable future, as it always has, even in the most rip-roaring of bull markets, it's going to come and check its 200-day moving averages. Those are the tether it's attached to. So even if it's going to continue this super-duper bull march, it's not going to do so forever. The longer and farther it gets away from the 200s, the more the odds increase of that mean reversion that's going to come back and test it. So anyway, that's one to watch. And we'll see. There's other things that could certainly trigger things. All right. Anywho, they report tomorrow, so probably, I guess, maybe not any big fireworks between now and that would really be Thursday, regular session, because Alphabet reports tomorrow, Wednesday after the close. Um, or, again, watch the BDCs. Um, that's also a potential catalyst. They're pushing the red line right now. The key support level about 1350. So anyway, let me wrap the video up here. As always, I'll continue to hunt for some new trade ideas, keep spreading our bets, and just continue to fight the fight. While the markets go nowhere for months now, the only way you're going to beat the market in a period like that, the easiest way, is just individual security selection. All right, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.